73.23% of billionaire Bill Ackman's portfolio is in these four stocks here: Lowe's, QSR, Chipotle, and Hilton Worldwide Holdings. Not much change in his portfolio from the third quarter to the fourth quarter. If you watched my video on his holdings in the third quarter, you will have noticed very little change in his portfolio. What we do notice here is an increase in his holdings of the Howard Hughes Corporation by 16.7%. And that's about it. No other big changes in his portfolio, sticking with what he feels is an optimal mix here. To me, it looks like a combination of things here. For one, taking advantage of the economic reopening here with QSR restaurant brands, Chipotle Mexican Grill, and Hilton Worldwide, betting on the fact that consumers are unleashing pent up demand to get out of the house, right? We were locked up, we were cooped up at home for almost 2 years. We want to get out, we want to go to restaurants, we want to go to bars, we want to travel, we want to experience things other than our four walls inside of the house. And so that's a bulk of his holdings here: 31, 48, 49% of his portfolio in these three stocks here, capitalizing on the economic reopening. And then an interesting one with Lowe's here. Lowe's, in my opinion, an excellent company, run by an excellent management team. This is one of the companies that I often say has done an excellent job during the pandemic and after the pandemic. There was a lot of businesses that thrived during the pandemic. Sales, profits exploded, but in the aftermath, they are struggling. Two examples I'll give you with that is Amazon and Peloton. They both thrived during the pandemic, but in the aftermath, they're struggling. Um, Lowe's, Home Depot, another one, its rival Home Depot and Lowe's, they've done really well both during the pandemic and now in the aftermath, even though economies have reopened and consumers have more choices on where they can spend their time and money. Lowe's sales have fallen, yes, and profit growth has decelerated. However, it's not a big, huge fall off like some of the other companies that were pandemic beneficiaries, and they didn't have the same problems earlier and during the pandemic with out of stock, long shipping times, all of those things relating to inventory management, customer relationship management. They did a really good job with that. And now let me show you this metric here. Looking at valuation, Lowe's here in the purple is trading at a forward PE ratio of 15.31. The stock is not expensive. It's relatively inexpensive, I would say. It's trading at a price that's less than the average forward PE ratio in the S&P 500. So you've got a company with a proven good management team in an industry, in the home improvement industry, with not how do I word that? Not, I don't want to say weak competition, but the competition is not as fierce as in other industries, right? Lowe's and Home Depot are not aggressively battling, lowering prices, advertising, offering promotions to try and steal customers away from each other, right? So this is a tradition, a more traditional, closer to an oligopoly type of industry where profits are it's more favorable to investors compared to a more fiercely competitive industry, like, for example, rideshare and food delivery. DoorDash and Uber Eats are in fierce competition. That really sucks for investors. Lowe's is not in that industry, so benefiting from that, I can see why Bill Ackman is attracted to Lowe's stock. And for that matter, the industry overall. I like Lowe's stock. I also like Home Depot stock, so I can understand that one. The restaurant brands, QSR, again, not very expensive, trading at a forward PE of 21.55, benefiting from that reopening of the economy. The same with Hilton Worldwide, a forward PE of 26, benefiting from that reopening economy. This is curious, in my opinion. The Chipotle forward PE of 39.23, one of the most expensive stocks in its industry, right? If you compare Chipotle with other rivals, one of the more expensive ones, right? You could just compare it with restaurant brands trading at nearly twice the multiple of restaurant brands. But I can expand this and I can include McDonald's, Domino's, Starbucks, all these other kind of away from home restaurants, you could say. And Chipotle is the most expensive out of nearly all of them. Now, I'll give you this fact that Chipotle is another one of those companies that is run by an excellent management team, and they've delivered on their promises, reaching targets, reaching per restaurant milestone targets, increasing those targets, increasing the long run growth rate targets and estimates. And so I can understand the bullishness behind the company. I don't know if I would want to pay a forward PE of 39 for essentially a restaurant business, right? I don't know, but I can understand what has attracted Bill Ackman to the stock, even though it's not very attractive to me personally. All right, so there you have it. A little change in Bill Ackman's portfolio between the third and fourth quarters, reiterating his commitment to these four stocks, doubling down on betting on the consumer continuing to unleash pent up demand for getting out of the house, going to restaurants, and traveling. All right. As always, I truly, truly appreciate your viewership. Thank you for tuning in. I hope you'll see me next time for another video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.